Hi, I'm Thomas. Welcome back to Financial Management. Today's topic is capital investment. Capital investment refers to investment in long-term projects. These could be new fixed asset purchases. This could be an expansion of operations, so investing in more than just assets, a package of assets, a new operation, or an acquisition of another company. These would be examples of capital investment, and the tools we're going to learn relating to analysis of capital investment are relevant to these kinds of decisions. We'll look at 4 methods of capital investment analysis: 2 relating to discounted cash flow, which are net present value and internal rate of return, and 2 methods which are not discounted cash flow based: payback period and accounting rate of return. Net present value is a formula that looks at the present value of future cash flows, discounting those back based on the number of years into the future they're expected, and an applied discount rate, the applied required rate of return on the project. And the net present value is the sum of those present values, the present values of the future cash flows, less the initial investment in the project. If a number is 0 or greater, that is a favorable result. That is an acceptable project. We are achieving at least our desired return. A result that is negative means that it is not an acceptable project and we should reject it. Internal rate of return, IRR, is the discount rate at which NPV is exactly 0. And for our purposes, we'll consider IRR based on these guidelines. If we calculate a positive NPV, then we know IRR is something greater than the discount rate. If we calculate a negative NPV, then IRR is something less than the discount rate. And if NPV is exactly 0, the IRR is equal to the discount rate. So we won't be calculating a precise IRR other than in situations in which NPV is exactly 0. We are simply applying these concepts to understand how to have a sense of the direction of IRR or quality of IRR relative to the return rate used in the NPV calculation. It is possible with a financial calculator to calculate an exact value for IRR, but that's beyond what the requirements for this course are. Payback period is the measure of how much time it takes for us to get our initial investment back. We can have 2 kinds of cash flows. One is a stable cash flow, the same cash flow coming in every period, in our case every year, and the payback period here is calculated as your investment divided by your annual cash flow. And a more advanced calculation is for projects with non-uniform cash flows, not the same amount of cash flow every period. And the calculation here is the number of years before the year of recovery, plus some additional cash flow in the following year to fully recover the initial investment. This calculation will be clearer when we work through our examples together. The accounting rate of return is based on accounting, and the major or the primary accounting measurement for this calculation is net income, which is a different number than cash flow, primarily because of depreciation. So our formula is average annual net income divided by initial investment. Occasionally you will see this calculated as the initial investment divided by 2, based on a different perspective of the analysis or a different perspective on what we're investing to generate the accounting return. We'll use the first formula here on the screen for our calculations. Now we're going to see examples of all 4 calculations with 2 projects, Project A and Project B. Both have investments of $50,000. Both have required returns of 9.5%. The annual cash flows and the disposal proceeds vary from one investment to another. A quick glance shows you that Project A has larger annual cash flows compared to Project B, and a smaller disposal inflow relative to Project B. So we'll see in our analyses how these different cash flow patterns affect our calculations. Looking at Project A, first calculating our net present value, which is positive. We have a net present value of $5,798, and here we have applied our present value calculation to the annual cash flows over the 5-year investment period. And for IRR, we are simply noting that as the NPV is positive, IRR is greater than the discount rate of 9.5%. Now looking at the payback period, our first row is cumulative cash flows, accumulating the cash flow, not just looking at 1 year at a time, but the accumulation as of the end of the year. So for example, as of the end of year 2, all historical cash flows sum to $10,000. Then we're looking at the investment balance, the net amount invested reduced by the cumulative cash flow that's come in as a result of the performance of the project. And you can see that in year 4, the investment balance becomes positive. That's the year in which we reach the point where we have received all of our initial investment, and then we've actually received additional cash flow. So the calculation process is that we move 1 year back from there to year 3. We know that we need 3 full years to collect our initial investment, to recover our initial investment. From there, as of the end of year 3, we have an additional $18,000 that is the shortfall. That's the additional amount we need to collect to recover our full investment. The total cash flow in year 4 is $20,000, so we need 90%, almost a complete year, 90% of the year 4 cash flow to fully recover our investment. And in months, that is 10.8 months. So our payback period is 3 years and 10.8 months. This is the time in which we will fully recover our investment. Any cash flows beyond this point are simply additional cash flows coming in that we benefit from, but we're not considering in this calculation. And finally, our accounting rate of return. Here we're calculating income, a rough measurement. This isn't precise, but for our purposes, it's a good measurement of net profit. Our cash flow minus depreciation. And we can see that in year 1, that's actually a negative number. Sometimes net income is positive, sometimes it is negative, and over time we see the number goes from negative to 0 to a positive. And in totaling years 1 through 5, we have $22,000 of income. The average number is $4,400, and that average divided by our initial investment, $50,000, gives us an accounting rate of return of 8.8%. From an accounting standpoint, the net income that we would report for this project on an annual basis, averaged over the 5-year life of the project, is 8.8% of our investment. Now let's go to Project B and look through the same 4 calculations. NPV is $64,483, which is positive and much higher than the Project A NPV. IRR, again, as NPV is positive, we know that IRR is something greater than 9.5%. In this case, given the strong NPV, the IRR is probably much higher than 9.5%, but we will simply leave our analysis as this qualitative greater than 9.5%. Looking at the payback period, in the case of Project B, we need to get to year 5 for the investment balance to go positive. That means that we need 4 full years of cash flow, plus some portion of year 5. The additional cash we need in year 5 is $30,000. That was the shortfall in the investment balance at the end of year 4. As a percentage of the year 5 cash flow, that is 19%, which is 2.3 months. And the payback period for Project B is 4 years, 2.3 months. Finally, the accounting rate of return. In the case of Project B, we see that when we subtract depreciation from cash flow, we have a negative accounting profit in each year of the project. They're all the same number, so our average is $5,000, the same as the annual amount of $5,000. Or another way of looking at this, we sum the 5 years of income to get a total loss of $25,000. divide by 5 years. That gives us an average annual number of 5,000 loss, divided by 50,000 in investment, is an accounting rate of return of negative 10%. Now let's summarize and evaluate our results. For each of the projects, I'm giving the result of each of the 4 analyses, and I've boxed the better result, the preferable result. And we see there's some inconsistency. Project B is favorable in net present value. Project B is also favorable in IRR. It's not clear here in the descriptions, but because the NPV is so much higher than Project A, whatever the IRR is, it's going to be higher in Project B than in Project A. While both of them are greater than 9.5%, it is clear that the Project B strong NPV means we're also going to have a relatively strong IRR. In the case of the payback period, Project A is better. We recover our investment in a shorter period of time. That's the objective of the payback period analysis, to determine how much time it takes for us to recover our investment. The less time, the better. And in looking at accounting rate of return, we also have a better result with Project A. We have a positive number compared to Project B's negative number. Clearly, a positive accounting return is better than a negative return. How do we reconcile these conflicting results? The general rule is that discounted cash flow techniques are preferable to techniques not using discounted cash flows. So we're going to focus on NPV and IRR because they're factoring in the time value of money to our analysis. In addition to that, the payback period doesn't consider what happens after the payback period. If there's a long period of additional cash flow coming in, the payback period disregards that. And in the case of the accounting return, we're only analyzing our change in annual cash flows. We're not considering what happens at the end of the period when we sell the investment and have an additional cash inflow coming in. So for several reasons that we're describing, the NPV evaluation along with the IRR evaluation are where we want to focus. And since the NPV is so much stronger, is so much higher for Project B than it is for Project A, we're going to select Project B as the project to invest in. If we have funds that are sufficient for both projects have a positive NPV, both projects have an IRR greater than 9.5%, both projects give us a payback in a reasonable period of time, both of them give us a payback in less than 5 years, and while the accounting rate of return is negative in Project B, that is only one measurement. It's not taking into consideration the additional proceeds that come at the disposition, the disposal of the assets we're using for Project B. So we will, in this case, consider that accounting rate of return as one of our tools, but overall, if we have funds for both projects look attractive. Assuming we have funds for only one project, we can't do both, Project B is favorable. This concludes the lecture Capital Investment. When we meet together in class, we'll work through examples of each of these tools to give you the opportunity to make sure you not only know how to perform the calculations, but also how to interpret the results and make a decision between more than one project option. I look forward to seeing you then.